Okay, let's unpack this. We are diving into a really crucial topic in financial accounting today. It's kind of like a truth serum for a company's balance sheet.
Mm-hmm.
We're talking about the impairment of assets, specifically under International Accounting Standard 36, or IAS 36.
Yeah, it's a standard that really demands honesty, doesn't it? The moment a company realizes an asset, could be a factory, a brand, whatever, is worth less than what's on the books.
They have to face it.
They have to address it, exactly. Without something like IAS 36, companies could just, well, keep those potentially inflated historical costs on their books forever.
Right. So our mission today, for you listening, is to basically give you the roadmap. We want to understand not just what impairment is, but what triggers it. How do you calculate it? What about when assets are sort of bundled together? The goal really is to demystify how companies manage this risk of overstating what they own.
And fundamentally, the core idea of IAS 36 is actually pretty simple, quite elegant, really. Assets of an entity are carried at no more than their recoverable amount.
That's the ceiling.
That's the absolute ceiling for value.
Okay, that sets us up perfectly for Section 1 then.
Yeah.
Defining and measuring this ceiling. So when does impairment, this necessary but maybe unpleasant accounting thing, actually happen?
Well, impairment exists when the asset's carrying amount, what the books currently show is actually greater than that critical figure. It's a recoverable amount.
Okay.
And calculating that recoverable amount, that's the key. We really need to nail that down. And it comes from a comparison.
Right, and this comparison seems to be where the sort of economic logic really kicks in. The recoverable amount is always the higher of two different values, isn't it? The standard makes the company look at two potential outcomes and, well, pick the best one.
That's correct. You have to look at both. The first is the fair value less costs to sell. Think of that as basically the net cash you'd get if you just sold the asset today.
Okay, the walkaway price.
Pretty much. And the second one is the value in use.
So the company essentially have to ask, what's better for us? Sell it now or keep using it? And by making them pick the higher number, the standard is sort of acknowledging rational economic thinking, right?
All right.
A company wouldn't keep using an asset if selling it would net them more cash than they could ever get from operating it.
Precisely. That's the logic. Now, if they go with fair value less costs to sell, that can be fairly straightforward to measure. Maybe there's a binding sale agreement, or you look at current market prices and subtract the costs of selling.
Seems reasonable.
But the value in use calculation, that's usually much more involved. It requires looking into the future.
Okay. That's where we get into forecasting and the time value of money, I assume.
Exactly. For value in use, you're estimating all the future cash inflows, the money the asset is expected to generate over the rest of its life, and then you have to discount all those future amounts back to what they're worth today, their present value.
Makes sense.
And this is important, those future cash flow estimates. They have to exclude cash flows related to financing, like interest payments or income taxes. We're trying to isolate the value of the asset itself.
Got it. Independent of how the company financed it or where it pays taxes.
Right.
Okay, let's look at this higher of rule with a quick example from the material. Say we have asset B. Its net realizable value, the selling price minus costs, is $150. But its value in use, what they can get from operating it, is only $130.
Okay. In that case, the recoverable amount is $150. That's the higher value. So if the carrying amount on the books was already $150 or less, then there's no impairment. The asset's value is capped at $150.
Simple enough. Now, what about asset C? Let's say its carrying amount is $120, but its net realizable value is only $100, and its value in use is even lower, say $90.
All right. Comparing $190, the higher value is $100. So the recoverable amount is $100.
Okay.
Now, since the current book value, the carrying amount is $120, and that's more than the $100 recoverable amount.
Impairment.
Exactly. That company has to recognize an impairment loss immediately. It's $120 minus $100, so a $20 loss. And that write-down, it hits the profit and loss statement straight away. It's that instant recognition that the asset's economic prospects have dimmed.
Okay, let's make this even more concrete. The sources give an example of a company car involved in a pretty bad accident.
Right, the accident scenario. Let's say just before the accident review, the car had been depreciated down to a carrying amount of $7,000.
Okay.
Because of the crash damage, its fair value less costs to sell. Basically, what they could get for the wreck is estimated at $3,000.
Not much.
No. And its value in use, I mean, the cash it could generate if they somehow kept it running, which seems unlikely, is estimated at only $1,000.
Okay, so comparing $3,000 from selling it versus $1,000 from, well, somehow using it.
Yeah.
The recoverable amount is clearly $3,000. That's the best they can get.
That's the ceiling. So the impairment loss is calculated by taking that $7,000 carrying amount and rating it down to the $3,000 recoverable amount.
Which means a $4,000 loss.
A $4,000 impairment loss, yes. It really crystallizes the idea. The accident slashed the car's economic utility, and accounting rules demand that reduction is shown immediately.
Which brings us neatly to the triggers. I mean, what's fascinating here is that companies can't just sit around and wait for an accident. The standard actually requires them to actively look for signs, for indications of impairment at every reporting date.
Absolutely. You can think of them as red flags. And they tend to fall into two broad categories, external and internal.
Okay.
So on the external side, you're looking at market forces, things like a sudden, sharp drop in the asset's market value, way more than just normal wear and tear would explain.
And the sources also mention big picture stuff like adverse changes in the whole environment the company operates in, technology, the market, the economy, even legal changes.
Yes. And there's one we really need to highlight. Increased interest rates. This is a big one.
Why specifically interest rates?
Well, rising rates don't just potentially hurt the company's overall financial health. Mathematically, they directly increase the discount rate used in that value in use calculation we talked about.
Right. Higher discount rate.
Means future cash flows are worth less today, so it automatically pushes down the calculated recoverable amount. It's like a direct lever that can trigger impairment reviews.
Okay, that makes sense. What about the internal red flags? Things happening inside the company.
These are often signs that things aren't going to plan with the asset itself. Maybe there's clear evidence of obsolescence or physical damage.
Like the car crash.
Exactly. Or perhaps significant changes in how the asset is being used. Maybe a factory that was making widgets is now just being used for storage. That drastically lowers its earning potential.
Right. Or maybe just the internal forecasts look bad.
Yeah. Simply put, the economic performance of the asset is, or is expected to be, substantially worse than originally projected. Budgets are being missed, that kind of thing.
Now, there's a really important exception, isn't there, to this whole look for indicators approach. IAS 36 actually mandates an annual impairment test every single year, regardless of indicators, for 3 specific types of assets. Why the forced review for these ones?
Yes, the mandatory test. This is reserved for assets where their initial value is, let's say, inherently more subjective or potentially harder to pin down reliably.
Okay, like what?
We're talking about, first, goodwill acquired in a business combination. Second, intangible assets that have an indefinite useful life, think certain brand names maybe. And third, intangible assets that aren't even available for use yet, like R&D capitalized under specific rules.
So goodwill, that premium you pay when buying another company over its identifiable net assets, you have to test that every year, even if the acquisition seems to be going brilliantly.
Correct. Every single year. The reason is that goodwill is probably the most subjective asset on the balance sheet. It represents future economic benefits, synergies, things that are hard to measure.
Right.
So by forcing this annual test, the standard stops management from just letting that potentially optimistic subjective value sit there on the balance sheet year after year, even if subtle market signals suggest it might have faded. It forces a regular reality check.
Okay, that mandatory check makes sense for those specific assets. Let's move to Section 2 then. We've covered the rules for a single asset, but, I mean, let's be real. Most assets don't operate in a vacuum, do they? A machine on a factory floor doesn't earn money all by itself.
That's exactly the problem the standard addresses next. Sometimes you just can't determine the value in use for a single specific asset because it doesn't generate its own distinct cash inflows.
So what do?
You have to zoom out. You look at what's called a cash generating unit, or CGU.
Okay, CGU. And the definition seems quite specific here. It's the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets.
Exactly. Think about a big company, maybe a national restaurant chain. The head office building doesn't really generate cash on its own, but all the assets within one single restaurant, the ovens, the tables, the brand signage at that location, they do work together to generate cash flows pretty much independently from the restaurant in the next town over.
Okay, so that single restaurant could be a CGU?
It typically would be, yes. It's the smallest part of the business you could potentially sell off, and it would still function and generate revenue on its own.
Got it. So how do you test a whole CGU for impairment? Is it the same logic?
It's the same core logic just applied to the group. You compare the total carrying amount of all the assets within that CGU, the building, the equipment, any allocated goodwill, everything, to the total recoverable amount of that entire unit treated as one thing.
And if the total carrying amount is higher than the total recoverable amount?
Then the whole CGU is impaired. You have an impairment loss for the entire unit that needs to be recorded.
Okay, but how do you apply that loss? You can't just slash the value of everything equally, can you?
No, absolutely not. And this is where the allocation rules get very specific. And they actually reveal a sort of hierarchy of asset quality, you could say.
A hierarchy.
If a CGU is impaired, the standard mandates a strict, specific order for allocating that loss. First and always, first you have to write down any purchased goodwill that's been allocated to that CGU.
Goodwill takes the first hit.
Oh.
Always. Why?
Because it's seen as the most, well, conceptual or softest component of the CGU's value. It's the premium paid, not a physical thing, so it gets reduced first.
Okay, makes sense. Reduce the goodwill.
Reduce it potentially all the way down to zero if the loss is big enough. Only after goodwill is completely written off do you then allocate any remaining impairment loss pro rata across the other assets in the CGU.
Pro rata based on what?
Based on their respective carrying amounts before the impairment allocation started. So proportionally across the remaining tangible and identifiable intangible assets.
Okay, let's try the SEBCO example from the sources. That should help illustrate this sequence. So the SEBCO CGU has a total carrying amount of $155 million.
Right.
But its recoverable amount is only $85 million.
Okay, so 155 minus 85. We've got a total impairment loss for this CGU of $70 million that needs to be allocated.
Right, $70 million. Now, following the hierarchy, what's step one?
Step one is actually to check if any specific asset within the CGU is obviously impaired on its own or completely worthless. The sources say in this case, there's a technology asset carrying amount $5 million that's basically useless now due to some failure.
Okay, so that specific asset gets hit first.
Yes, you write that technology asset down to zero immediately. That absorbs $5 million of the total $70 million loss.
Okay, so $5 million dealt with. We still have $65 million of impairment lies to allocate.
Correct. Now we move to step two in the main hierarchy, goodwill. The example states SEBCO has $20 million of goodwill allocated to this specific CGU.
So, following the rule?
That entire $20 million of goodwill must be written off next. Reduce goodwill to nil.
All right, so we've now dealt with $5 million for the tech asset plus $20 million for goodwill. That's $25 million total allocated so far.
Leaving $45 million, 70 meters, 25 meters of the impairment loss still remaining.
And now this $45 million gets spread across the other assets.
Exactly. That final $45 million is allocated pro rata to the remaining assets in the CGU, which in this example are things like brands, land, and buildings based on their relative carrying amounts.
So the more valuable assets take a proportionally bigger hit of that remaining loss.
Correct. This mandatory sequence, hitting specific known impairments first, then goodwill, then spreading the rest. It kind of protects the core tangible assets until the more subjective or specifically damaged ones have been fully written down. It forces transparency.
That strict order is really interesting. It tells you a lot about how accountants view the quality of different assets.
Okay.
Let's shift gears to Section 3, the second chance. Can impairments ever be undone? Can you have a reversal?
Yes, you can. Sometimes conditions improve, right? Maybe the market for the asset bounces back strongly, or the economic environment gets much better than expected when the impairment was first recognized.
So if things turn out better than predicted,
then the asset's recoverable amount might increase again. And if it increases above its current impaired carrying amount, the company might be able to reverse some or all of the previous impairment loss.
are there specific indicators for reversal, just like for impairment?
Yes, similar logic applies, but in reverse. Favorable changes in market value, improvements in the technological or economic environment, evidence that the asset's actual performance is better than forecast.
Okay. And if you do reverse an impairment, how's that treated?
Generally, the reversal is recognized immediately as income in the profit or loss statement. It boosts the current year's profit.
But I sense a but coming. There must be exceptions or limits.
There's a huge one. Remember goodwill.
The subjective one that gets hit first and needs an annual test.
That's the one. The rule is absolute. An impairment loss recognized for goodwill cannot be reversed in a subsequent period, ever.
Wow. So once goodwill is written down, it stays down. Permanently?
Permanently. It's a one-way street for goodwill impairment.
Okay, that's a massive exception. What about reversing impairment on other assets, like the factory equipment or the building? Is that straightforward?
It's possible, but here's where it gets really interesting. As you said earlier, there's a crucial constraint, a very important limit.
Okay.
The reversal cannot write the asset's value up higher than what its carrying amount would have been if the original impairment had never happened.
Whoa, okay, unpack that. So you can't just write it up to its new, higher recoverable amount.
Not necessarily. You have to calculate what the asset's value would be today if you just kept depreciating it normally all along without ever recording that impairment loss in the past. Think of it as its depreciated historical cost had impairment never occurred.
Right. So let's take that car from the accident example. Suppose it was impaired down to $3,000. A year later, maybe classic car values boom, and its recoverable amount jumps to $10,000. You can't just write it up by $7,000.
No, you'd have to figure out if the accident hadn't happened and we just depreciated the original $7,000 or whatever it was pre-impairment for another year, what would its carrying amount be now? Let's say that calculated number is only $6,000.
Okay.
Even though the recoverable amount is now $10,000, you can only reverse the impairment up to that $6,000 ceiling. You can only write it up by $3,000. From $3,000 to $6,000?
I see. It stops companies from using a lucky market swing after an impairment to essentially book an artificial profit, boosting the value beyond its original depreciated path.
That's precisely the point. The asset's carrying amount after reversal can only be the lower of 1, its new recoverable amount, and 2, that theoretical carrying amount it would have had without the original impairment.
You're just undoing the past loss recognition, not performing a full revaluation upwards.
Exactly. You're restoring it to where it should have been on its original depreciation schedule, effectively.
Okay, so wrapping this up, what does this all mean for you, the listener, trying to make sense of company accounts? I mean, this deep dive really shows that value in accounting isn't static, is it? It's dynamic, and it's governed by these really strict, quite logical rules under IAS 36. It's clearly not just about what a company paid for something years ago. It's about what that asset can realistically generate now or what it's worth in the market now.
And understanding this framework, I think, is absolutely key if you want to properly interpret financial statements. When you see a company report a big impairment loss, they're being forced or choosing proactively to recognize some kind of risk.
Right. A reduction in expected future cash flows, maybe a hit from those rising interest rates we discussed, or maybe just that an asset is becoming obsolete.
It forces the balance sheet to be a more honest reflection of the underlying economic reality, even if it means reporting some bad news in the short term.
Which actually leads to a pretty interesting final thought, doesn't it? Thinking about that strict rule.
Yeah.
The one that says impairment of purchased goodwill can never be reversed.
Yeah, that permanent write-down.
What does that finality, that one-way street, really tell us? Doesn't it kind of imply something about how difficult, how subjective, maybe even how speculative that original measurement of goodwill was during the acquisition?
That's a great point. It almost suggests an admission by the standard setters themselves that, hey, this goodwill number is often based on projections and synergies that are really hard to pin down and might not materialize.
So the fact you can never write it back up, it's like saying we're skeptical about this value from the start, and if it goes down, we're not letting you pretend it magically reappeared.
It certainly suggests that we as users of financial statements should probably view those big goodwill figures on a balance sheet with, let's say, a healthy dose of suspicion right from day one.
Definitely something for you to mull over.